PayPal, 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 PayPal. That's what I've been hearing for the last couple of days, whether it's on YouTube, on X, on Reddit, mainstream media, you name it. Everybody's talking about PayPal as if this is a new company, up-and-coming company, fintech startup that is suddenly emerging. I mean, it's getting ridiculous, right? And then there is these comparisons to Meta, because Meta last year, the stock crashed and the sentiment was horrible, and now the same thing is happening or happened with PayPal, right? Sentiment is horrible, stock has crashed. Then we put 1 plus 1 equals 2, so PayPal equals Meta. Voila. That's the investment case right now. Because PayPal equals Meta, this means that PayPal right now is a buy, and 6 months from now, the stock will go up more than 3 times. Well, I don't think so. As I've explained on X, by the way, you can follow me there if you want more engagement, questions, whatnot. Link is down in the description. The difference for me personally, of course, is that yes, PayPal is great as a service. I use it weekly, if not monthly, to pay for stuff, even though it is expensive if you do exchange currency and stuff like that. But it is not a necessity, right? It is not a necessity. For me, Meta offers products that are necessarily for me on a daily basis. Whether it's the messaging app, whether you're using Instagram shops, you name it, these are apps that I use daily that are necessary for my life, and they are making money from that on a daily basis. There are 3 billion people using their services. 3 billion people. Now, of course, yes, one of the main reasons why suddenly Meta stock has gone up is not only because of the success of Reels and the monetization of it, and the fears of, well, TikTok destroying their business, the fears of Apple's update when it comes to privacy, hurting the ad business, which were all true, right? Which were all true for a short amount of time that lasted a couple of quarters, of course. But on top of that was the spending. Way too much spending during difficult times that just didn't make any sense. So what happened? Well, they basically reduced the spending. When you reduce the spending and you're such a big company that usually has a lot of free cash flow each and every quarter, yes, then magically the whole thing turns around. Now with PayPal, yes, they did reduce costs, which is why we've seen that EPS has grown quite nicely year over year. But there are still some struggles with the business, right? Take rates going down, transaction margin is going down. We've had for a long, long time a big question mark on who's going to be the next CEO. Now we've got that answer, more on that a bit later. Now, what we also know is this, for example. This is the state of PayPal right now, market cap of $65 billion, trading at a forward PE of just 11.2 times. Revenues throughout the years, yes, have gone up. Return on equity is still over 20% here. Gross profit margin, as you can see, has been dropping. Now, from a PE to growth ratio in the next 12 months is just under 1 time. So, is it cheap? Yes, it is cheap. But there is obviously risk attached to it. Is growth going to reaccelerate? Are margins going to go up again? You have to take that in consideration. And here, yet again, you can mix it up, right? You look at free cash flow in the last 12 months because we had one bad quarter here, but hey, it's just because of an acquisition. Let's call it the same as previously, around $5 billion, the same as the expectations for later this year, $5 billion. And so what you can see is that they can buy back shares because of that free cash flow. Now, since the shares of that company have gone down, right, the stock price has gone down, and they keep producing $5 billion, $4 billion in free cash flow, they can just buy back more and more shares for the same amount of money, which is obviously great for shareholders. But if you look at the bigger picture here, for a company like PayPal, you can see this is obviously on the trailing 12 months, but still, overall, they're always around that $4 to $5 billion in free cash flow. Why isn't that increasing, right? You're a business that's supposed to innovate, to grow, become more profitable over time, which means that you'll generate more free cash flow. With that, you can do M&As, or you can just buy even more shares. So the question here is, are we going to stay at around $4 to $5 billion in free cash flow, or is this going to increase in the future? remains to be seen, of course, with the new CEO. Now, the new CEO comes from Intuit. He's very, very specialized when it comes to the small to medium-sized businesses, which is going to be extremely crucial for the future of PayPal because of the growth in Braintree, unbranded checkout, which is obviously one of the reasons why margins are taking a hit as well. Now, with regards to unbranded checkout, Braintree, there is, of course, a competitor that reported earnings this week, and that is the Dutch company Adyen. So as you can see here, they missed on the estimates when it comes to revenue, EBITDA, EBIT, and EPS. But what's even more interesting here is this processed volume up 23%. You might say it's up 23%. It's pretty good. Yes, it's pretty good. But if we have a look at their earnings call, you can see here, if you look at online where we started the company, we see lower growth than what we hoped for. And the reason for that is that we have seen increasing competitive pressures in North America. And that's, to my view, related to a high interest rate environment. More companies are looking at the bottom line, and that's an environment in which they try to see if cheaper alternatives work. Who might that be, you ask? Well, let's go back to PayPal's earnings report. And so in PayPal's earnings report, you can see here we continue to see impressive traction in the PSP business with our growth rates nearly 30% on a currency neutral basis. Many of the largest tech companies in the world are now either using our Braintree capabilities or are in deep strategic negotiations with us to do so. So some might say Braintree is accelerating and taking more market share, which is extremely positive for the long-term investors in PayPal or for those that are thinking of buying these shares right now. Now, currently, if we look at what the analysts are saying, right, if we look at what Wall Street is saying here, the average price target for PayPal sits at $91, meaning there's a difference here between the stock price today, which is just under $60, and the price targets, 55% upside. Now, of course, analysts can change price targets as they go, right? There's news coming out, suddenly they change a couple of dollars here and there, EPS for 2025, 2026, and suddenly the price target has changed. But still, 55% growth, even if it comes down a little bit, let's call it 30% growth, still quite a nice upside, don't you think? Now, of course, I agree, we have a new CEO. Let's see what he will be able to do. Let's see what happens in the second half of 2023 and especially going into 2024. Are margins going to be higher? Are we still going to take a hit more and more? How fast can that new CEO impact the PayPal business? Because he is coming in to a company that has a rich history that is still generating $4 to $5 billion in free cash flow. So he has things to work with. Yes, they are struggling, but I do think he can turn this ship around. Now, me personally, I haven't bought any PayPal shares, so I'm not here trying to pump this stock or anything like that. I've said the same thing over and over again. You buy PayPal, you know that you're getting those $5 billion in free cash flow. You know that you're getting those buybacks as well. And so that will be one of the ways for your shares to be valued higher in the future. Now, when it comes to fiscal year 2023 guidance, they reiterated the non-GAAP EPS growth of around 20%, so that will come in just under $5 or so. Free cash flow here approximately $5 billion. And yes, they expect to repurchase around $5 billion worth of shares as well. Maybe they'll accelerate it right now in this quarter because the stock has taken a big hit. Remains to be seen. The last couple of things here for revenue. Second half of 2023 revenue is expected to be at least in line with the first half, which was around 7 to 8%. So high single-digit growth. And you can see here what the analysts are expecting for fiscal year 23, 24, and 25. Basically the same thing, high single-digit growth for fiscal year 24 and 25, a bit closer to 9%. This is, by the way, on Coifin. If you want to try it out, link will be down in the description below. When you look at EPS, as we've seen before, EPS, the bottom line, like with many other companies out there, is growing faster than revenue. Now, of course, if interest rates come down a bit in 2024, then I do expect many other companies to start focusing again on the top line growth and a bit less at the bottom line. And so if we look at the graph, you can clearly see what happens, right? We go out of the pandemic, stock basically crashed, completely decimated here, and now we're reaching that same point we were at back in May at around $60 or so. RSI is low, but not oversold. MACD is a bit bearish right now. Overall, if we go lower, which to be honest, I don't really see us doing so, right now the risk here is much smaller than the reward. There is still a lot of work to do at PayPal, especially with the new CEO coming in, but risk reward wise right now, I do think it is worth it. Again, I'll repeat myself, I do not own any shares of PayPal, but if I were looking for a short-term trade, by short-term I mean 6 to 12 months tops, I think this one could be an option. Of course, do share your thoughts down in the comments below. Have you been buying shares of PayPal? Have you sold it? Let me know down in the comments. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.